Hello, everybody. My name is Jason Krutzky, and we are here again with Mr. David Gibbs from CME Group. Last time we sat down with David, he gave us a high level view of CME Group and futures in general. Today, we're going to take a little bit lower level of an approach and just kind of answer some basic questions about trading futures. David, how are you today, man?
Terrific. Thank you, Jason. Glad to be here.
Awesome. Glad to have you here. As a new trader of futures myself, I've been trading them for just a couple of months now. There are some very basic questions that I have about them. So hopefully you can get these answered for us. I have a feeling you will be able to. The first question that I have is how does the continuous contracts versus the monthly contracts, how exactly does that work? When do new expiration dates start? I noticed this recently where they switched to the November, the December. I can't remember exactly what it was, but how do we know when new expiration dates start, and when is it best to switch to those new monthly contracts if that's what we're trading?
Well, it begins with an understanding of what the futures contracts are. And the important reference point there is that futures contracts, by their definition, have an expiration date. So every listed contract, depending on its contract identifier and its monthly expiration, is going to have a death date. And being mindful of that obviously is important if you want to maintain a continuous risk exposure to that particular product. So, for example, some contracts that are listed at CME have quarterly contract expirations, and they're on what we call the March quarterly cycle: March, June, September, December. Others might be monthly contracts where you've got regular calendar months: January, February, March, April, those types of things. Some of our historical commodity contracts might appear to a new market participant as being rather crazy. There are some that are monthly and then some that skip a month. And it goes back to their historical market developments and cyclical seasonal cycles. So, depending on the product itself, you're going to have a different expiration schedule. What becomes what we refer to as the front month or the lead month contract is driven by market activity. And as a market approaches, or as a contract approaches its expiration date, obviously anyone who wants to maintain risk exposure in that contract has to make a decision. And that decision is going to be one of three things. You either offset your position and flatten your exposure to that market, you intend and intentionally go to expiration, which could be, as we spoke last time, either a physical or a financial settlement. Or the third option is to roll that position forward. And rolling a position forward involves, in our business, what's called a calendar spread. So, for example, let's say that I'm in a stock index futures contract that expires in September. As that expiration date on the third Friday of September approaches, I've got to decide whether I want to maintain that exposure or not. If my choice is I want to remain exposed to that market, I'm going to need to sell my current month in September and simultaneously create a new position in the next quarterly contract, which is December. That's done very simply and very, very efficiently through the execution of what's called a calendar spread. And it's also referred to as a roll because you're rolling your position forward. So if I'm long a September equity index product and I want to stay long, I execute a spread whereby I sell the September and simultaneously purchase the December contract at a determined price differential. That's the spread difference. And that's actively quoted on our electronic platform, and usually, in many cases, at a reduced minimum tick increment. So it's not cost prohibitive to roll forward. It's actually very, very efficient. And that allows our market practitioners who want to maintain an existing position to efficiently and effectively move that position out to the next lead month expiration where the volume and the open interest lies. The only other caveat is that, as I said, each product has its own personality, and it might not necessarily be a quarterly contract. If it's say it's an agricultural or industrial commodity, you might go from November to March or March to May in some of those contracts, or you just might go month to month if it's a monthly contract. So be mindful of the product that you're looking at and always refer to the contract specifications that are available at cmegroup.com for every one of our listed products.
Is that considered a taxable event when you roll from one month to the next?
Well, anytime you're going to create and let me preface this by saying I'm not a tax lawyer. I'm not offering tax advice, and as an exchange, we're not allowed to comment on that. But
Oh,
anytime you're
okay.
going to offset a position, it seems to me that if that becomes an entry, a book entry, there's going to be some sort of a transactional consequence. Now,
Right.
having said that, I would also say, and this is again extremely heavily underlined, consult your own tax people about this. But futures in the United States under the Internal Revenue Service Code have a distinctly different tax treatment than, say, stocks or even options on stocks, in that they have what's called the 60/40 rule. And transactions which were put in play, or the tax consequences are designed to encourage commercial users to use our markets to hedge their risk. So the 60/40 rule suggests that 60% of the capital gain or loss to the transaction will be treated as a capital gain, 40% would be considered in income relevant. But again, refer to your own tax advice people about that. There could be some potential advantages to the futures and in terms of IRS treatment than regular stocks or options. Stocks that require you to hold the position for over a year to enjoy capital gain treatment. Futures are treated in a slightly different fashion, but don't take my word for that. In fact, don't take my word at all. Consult your own tax people for confirmation on that.
Got it. Okay, so for equity index futures, when does the new expiration date start if you're playing the monthlies? How does that work exactly?
Well, equity index products are an example of what we call a quarterly contract futures contract. So the volume in the open interest tends to concentrate in what are known as the March quarterlies. So you'll see March, June, September, December are the listed quarterly contract expirations. So we've just gone through a roll from September to December. The December 2022 equity index contracts are now considered the front month because the Septembers have expired last Friday. And they will remain the front month. The volume in the open interest will be heavily concentrated in the December contracts until roughly 7 business days prior to the expiration of the December contract, which will be the third Friday of December. The
Okay.
equity index complex is a cash settled contract, so there's no risk of any kind of physical delivery there. The delivery mechanism is very clearly defined and understood to be cash settled to the index value. So the open interest tends to be stays in the front quarterly contract until somewhere between 3 to 5 days prior to the roll, and then the roll concentrates. That's when the bulk of the open interest will flip over to the March contract. And that's when that calendar spread is narrowest, which means it's most efficient for long or short position to roll their position forward. You want to do it when the bulk of the open interest is going at the same time, because that's when the competition for the spread is the greatest and the price concentration is the narrowest.
Gotcha. So explain to me how a continuous contract works in comparison.
I don't know what a continuous contract is. All
Oh,
of our standard contracts have expiration dates. So at some point they die.
gotcha. Okay, so then a continuous contract is maybe only available in other terms. I've seen monthlies and then I've seen continuous. So I don't know if continuous is just for charting purposes or I actually
Well,
don't really know.
well, what you might be referring to, and I'm just taking a guess here, is that in charting services, they will tend to track what they call a generic front month. which means once that roll occurs, the pricing activity that you see on the charts then is reflected in price terms in what that next month will be. So, like if we went
Right.
back 5 years, obviously, a December 22 contract wouldn't have existed 5 years ago. So we take as you approach the expiration, when you roll the volume and the open interest, the charting behavior then tracks that quarterly contract and then references that price. So when you if you want to look at things from a technical and a charting perspective, obviously you want a longer framework to work with. Um, that's going to be, just in your mind, realize that it isn't a continuous price on the current front month, but has been a rolling price based on a continuous lead month pricing activity.
Got it. Okay. That makes sense. Next question is how does liquidity impact futures and which futures contracts are the most liquid?
Well, liquidity in any market is king. And in terms of our market, it's expressed in the dynamics of price discovery. The more participants you have competing for price, the more realistic the actual trading price is going to be, and the more efficient the transfer of risk is going to be, whether you want to buy risk or sell risk. In terms of seeking that liquidity, what's brilliant about the futures market is it's all publicly disclosed information. You can see not just the bid and offers on our system, but you can also see the depth of book, and not just the current bid and offer, but you can go back in and see as deep as the 5 and 10 deepest bids and offers. So you can always perceive how much liquidity is at least showing in the system. In terms of looking at contracts just to get the indication of which contract month is most liquid, I would always refer people to the website and look at the settlement pages, because then you're going to see not just the previous day's volume in each of those listed contracts, but equally as important, the contract's open interest. And I think we talked about this in our last conversation. Open interest is a futures term that tells market participants how many open futures contracts there are in that month contract. So let's just say, for example, we're talking about these equity index contracts that are now tracking the December contract as the front month. If you looked at the March 2023 or the June 2023 contracts, which are also listed, you'll notice that their volume is significantly lower than the December contract. And more importantly, the open interest is significantly lower. So if you were looking as a market practitioner who wanted to trade where the price activity was greatest and the liquidity was deepest, you would choose the December contract because it has the most trading volume and it also has the largest open interest. That tells me that I can get into the trade, but more importantly, I can get out of it. Whereas if I'm in a contract that has lower volume and lower open interest, I might be able to get in, but getting out might require a wider bid and offer spread, which could be more painful to me in terms of my outright and final performance. So always be mindful of not just the volume, but the open interest that backs it up, because that open interest is like potential energy. That tells you those market participants that are in open contracts have to do something with them. They're going to have to trade. And that means if they have to trade and I want to trade, I'm going to have a greater likelihood of trading success in terms of liquidity terms in contracts with larger open interest. So if you're looking for the most activity and the most active contract, it will tend to be the one with high volume and high open interest.
Got it. So focusing then on equity index futures, because I have a pretty decent sense that that's probably where most people who are new to futures get their start. They're trading ES, they're trading NQ, they're trading RTY. So the first question that I have is what are the advantages and disadvantages of micro contracts versus the mini contracts?
Well, there's really no difference in terms of their construction and their mechanics. They behave the same way. The only difference is that the micros have a significantly smaller notional value or a smaller contract multiplier. If we just consider the S&Ps, for example, the E-minis have a fixed multiplier of $50. That makes their contract size bigger, which means if I'm trying to construct what my risk profile is, I'm going to look at the notional value of the contract, the index price times its fixed multiplier. Let's say it's roughly $200,000 a contract at the moment. The micros price the same way. They have a $5 multiplier, so instead of a $200,000 risk equivalent, it would be $20,000. And then by extension, the initial margin that's required to secure those open positions is going to be smaller in the micros as well. Roughly, for rounding purposes, roughly 10% of what it would be for an E-mini. So, in terms of your markets, your audience's choice of product, it really becomes dependent on their risk profile. If they have the need for a higher contract because they need to use more of them and they want to pay less in terms of commissions on total number of contracts, the E-mini might be the choice. If their profile is smaller and they want greater granularity to the micro level, it may require more contracts, but you're going to get the closer number to your two risk factor. So the sizing, and that's why we offer the two sizes, is completely subjective, driven by the market users' needs, requirements, and financial capability.
Got it. But they're in their own unique spaces, right? If you're trading micros, you're not in the pool of people that are trading minis. You are only in the pool of people that are trading micros. Is that right?
That is absolutely correct.
Okay.
They're distinctly independent futures contracts that trade in their own markets. They're uh, they're comparable in terms of every other aspect except size, and they trade independently of each other.
Do more people trade micros than minis or vice versa?
Well, that depends on how you measure people. If you're
I
talking
guess
about individual traders, you might say there are more trading individuals trading micros. But in terms of are more institutions, for example, will trade
trade
the
minis,
e-minis.
right?
Um, you might have an institution where you have 20 traders that trade e-minis, all for the same institution. So is that a trader or is that 20 traders? So, it all depends on
Right.
what you're looking at here. But I would say if you're looking at individual sets of eyeballs that watch the markets, you're going to find that the micro contracts tend to be more self-directed, individually traded, and
Okay.
the e-minis might be characterized as more of a traditional asset manager institutional trade, but it also includes individual traders, where the
Got
micros
it.
we might characterize as being more self-directed individual and less institutional because of their size.
Okay. Got
So
it.
slightly
Cool.
different market profile of user.
Yeah. So then the next question is about kind of the difference between ES and QRTY. One of the first things that I noticed getting into it was the tick system. ES is 4 ticks per point, and Q's 4 ticks per point. RTY is 10. Why the difference in the point system between those three products?
It has to do with the size of the index itself. Um, and then the minimum tick increment is what our business line people determine is narrowest enough to create a good price discovery mechanism, but it also has to be wide enough for the market to be able to uh, make money on the risk. You'll notice that we don't have digital sized or decimal sized products. So that quarter tick increment in the E-mini S&Ps, for example, is there to create that $12.50 minimum tick increment. If it were, if it was decimalized, we would be printing a lot more in terms of different trading numbers, but you wouldn't be necessarily increasing the pool of liquidity. So in our world, we want to create a balance between efficient and effective price discovery and risk transfer, but also we need to concentrate liquidity so that people that want to cross the bid and offer uh, gap can do so and get a quantity that's meaningful. Uh, the Russell is a smaller index value, so it needs necessarily to have a smaller minimum price change increment in order to generate the same phenomena, in order to create a deeper pool of liquidity to make that next transaction more likely and more efficient.
Ah, okay. That makes a lot of sense. And that kind of leads me to my next question. One thing that I've noticed in my short time trading futures, NQ has a tendency to be kind of the most wild as far as price is concerned, meaning the price is jumping around very quickly. It's very volatile in comparison to ES, which then is kind of more volatile than RTY. And is this simply a factor of market participation? More people are trading NQ than are trading ES than are trading RTY, or is it because of the size of the markets themselves? What is the cause for that?
Well, it's even more basic than that, Jason. It boils down to what the index represents. And this is where the choice of index matters. It all depends on when you look at the US stock market, which is huge, deep, and diversified. The idea of benchmarking or indexing and having futures contracts on these various indexes really comes down to understanding what that index represents. So let's start with the S&P 500, which is a broad-based, diversified, large cap index, which means its construction of its constituent members, 500 of the largest large cap stocks, which means that the index is constructed on a calculation based on market capitalization. So you take the price of the company in its share value times the total number of shares outstanding to get its capitalization, and then S&P constructs that index based on the 500, or roughly now 505 largest capitalization companies, and then creates its index. So it's got 11 different sectors. It's diversified among the large caps. It represents roughly 80% of the total US market capitalization. If we look at the NASDAQ 100, it is also a large cap construction, but it only takes into account the top 100 large cap stocks of non-financial companies listed on the NASDAQ, the electronic market for stocks. So its constituent members are less diversified in that it doesn't take into account any financial companies and tends to be heavily skewed. Over 50% of its weighting is in high-tech growth stocks. So and then if let's I'll refer now to the Russell 2000, which is the RTY contract, which is based on 2,000 companies, but are in small capitalization calculations. So it's diversified like the S&P, but diversified among a universe of smaller capitalization companies. So they each reflect a different personality of the market. And at the moment, as you've rightly observed, it appears that the NASDAQ 100 is a little more volatile than those other two, because what's pushing the market around? Any changes of interest rates, especially higher rates, have a negative impact on growth stocks because of the present value calculation based on a forward curve over the last 2 years has been at very low rates. The expectation of higher rates, not just now, but in the future, is backing up or reducing the present value calculations based on higher forward interest rates. It impacts the growth market and the tech market more. And since it's more concentrated in the NASDAQ index, the NASDAQ futures appear to be a little more volatile. There were days like on Friday where the small cap market was much more volatile than the NASDAQ, and the Russell was actually more heavily traded than the NASDAQ. So it's market driven, but driven by the constituent construction of the underlying index that the futures contract is pegged to.
Got it. Okay, so that makes a ton of sense now, quite more
Well, and
than it did
I'll follow up
previously.
with an additional comment. It also shows you, while there's a high degree of correlation between those index products themselves, above 90%, You can also begin to detect that there's a relative value difference between them based on their underlying index's constituent construction. And this could provide opportunities for very smart traders to take advantage of that little relative difference between them. And that could result in things like spread trades, where you trade one index against another on a dollar neutral basis, but capture the relative difference between them depending on the dynamics of the underlying index itself. These are trades that the large hedge fund and private equity world have been doing for years in the cash market, but are now, because of these micro futures contracts, are available even to the smartest self-directed trader to capitalize on long short strategies within highly correlated products.
Got it. So for someone, I I had this question early on, kind of before I started getting into trading futures. For somebody who is used to trading ETFs, let's call it the SPY, the QQQ, and so on, IWM, does it behoove a trader who trades the ETFs to be watching what's going on the futures to help make their trading decision on the ETFs? And also vice versa, if you're trading futures, is it also wise to be watching the ETFs? Does one move before the other? Does one moving impact the other moving? Like, how do they play in relationship to one another?
Well, they're going to trade in such a high level of correlation that it will be apparently indistinguishable to the retail trader, because they're tracking the same index, and their
Got it.
construction of the product, the ETF and the futures contract, are both going to be trading, at a level of correlation above 95% to the index. Does one lead or lag? That's more of a function of liquidity and execution platform. So it would be impossible for me or you to come to some sort of a determination there. I would suggest that because they're going to be similar, one or the other is probably, from a market tracking perspective, is going to be equally valid in terms of following the broad marketplace and changes on the day, or even on an intraday basis. The choice of product, therefore, becomes more driven by the investor or the trader's uh, interest, capital, and credit, and what they're trying to achieve. And again, I would take us back to core principles here. An ETF is an asset. It does convey rights of ownership. When you buy the SPY or the IWM or the QQQ, you have rights of ownership. You're participating in dividend income stream from the minute you put that trade on. You have to pay 100% of the notional value of that underlying asset to own it. You're going to have to stay with that position for over a year to enjoy any sort of capital gain treatment on the net exposure, or be subject to income exposure if you trade under a year. Futures represent the same or replicate the same underlying beta risk, but it's a different construct in that it is not an asset. It does not convey those rights of ownership. You don't get dividend income in a futures contract, at least not directly. It's implied in the pricing mechanism, but isn't paid out, and therefore doesn't create that income stream or taxable income event. But they do have death dates, as we've talked about previously, and that they require, in order to maintain a continuous exposure, that quarterly roll. And that's an additional cost, because you're going to be selling one, buying another, creating a transaction. Uh, but in terms of the way they behave relative to their underlying index value, I think it's safe for me to say it would be indistinguishable between the ETF and the futures contract in terms of their relationship to the underlying. You're getting the same beta replication.
Got it. Okay, cool. Well, this has been really helpful. I guess the last question that I have is for somebody who has not yet gotten into trading futures, but maybe now they're interested and they want to kind of get a good understanding, good basic understanding before they get started. Where would you direct them to go to kind of learn all of the basics that they need to learn to get into it?
Well, I'm going to do some shameless self promotion and suggest that you go to cmegroup.com, and across the top of our webpage, there's a education tab. And when you click on that education tab, you can go to what we call CME Institute, and it's our trading portal. And in there, there are all kinds of courses, curriculums, product descriptions, archived webinars, even third party resources that refer to the products in the marketplace to give every one of you a deeper understanding of how our markets work, how to get started in trading. There's even a getting started trading futures curriculum that I would highly recommend be sought out because it walks through all of these really, really fundamental things that you need to know to be an intelligent trader in the futures market. So education at CME Group would be my first point of stop on that journey.
Awesome. Well, David, thank you so much for joining us today. This has been great. And I really look forward to talking to you again soon.
Thank you, Jason. Good luck to you.
Cheers. Have a good day.